Hi, we're going to run through this question, a sole trader question where you're asked to prepare a statement of profit or loss and a statement of financial position. For a sole trader, it's question 2 on page 123 of the manual. So for someone that doesn't have the manual, okay, that's the trial balance and there are the adjustments. So the first thing, like I said, with any of these questions is to go through the trial balance and identify your expenses, your assets, your liabilities. So I've done that down here. So cost of sale or cost of sale expense is anything to do with purchases. So purchases, here's cost of sale. Inventory, opening inventory at the start of the year, 1st of April. So the year end is March 16th. So our opening inventory in April 15, that increases our purchases. Then the next cost of sales is purchase returns. That reduces purchases. And always, if there's any closing inventory, that's a cost of sale expense and it reduces purchases because it's going to be sold next year, so it shouldn't be included in this year's purchases. And we go down, bank overdraft is a liability, and liabilities are on the credit side of the trial balance. Cash is a current asset. Discounts, so that's discount allowed and discount received. One is an expense and one is an asset. So if you're not sure which, rent and insurance is an expense, wages and salaries, office expenses, they're all on the debit side. So discount, the expense one, is on the debit side as well. So that's the expense, and the other income is 930. And if you look here, the sales revenue or sales income is on the credit side as well. So the other income, any other income account, such as discount received or rent received, interest received, will always be on the same side, the credit side, as sales. Carriage out, rent insurance are expenses. Provision for bad debts reduces receivables. So receivables is a current asset. So when you'll have current receivables minus 660 in your current assets. Fixtures and delivery van are assets, but they're long-term assets. They'll be there at, in over a year's time, you'd expect. So non-current assets. Wages and salaries, expenses, office expenses, receivables and payables. Once again, one's an asset. There are receivables, customers haven't paid us yet. Assets are on the debit side. If you look, you'll find non-current assets. Here, fixtures and delivery van, they're on the debit side. So the asset is on the debit side here, and the liability is on the credit side. Same as bank overdraft up here was on the credit side. So you'll get used to that as you do questions. The liabilities will always be on the credit side, the assets will always be on the debit side, and expenses are always on the debit side. And drawings reduces capital. So they're the breakdown of the accounts, and we have the adjustments to do then. So closing inventory is the first one. We're going to have a cost of sale expense. It'll reduce our purchases and also will show it in current assets. So wages due and office expenses due. So anything owing at year end, the rule is increase expenses and show a current liability. So wages is here. We're going to add 210 and we're going to add 20. So our expenses will be updated. Rent prepaid, reduce the expense. So we find rent prepaid, we've paid 1740, but some of that is for next year, 180 is for next year, so that's not this year's expense, so we reduce it in our expenses, and in our current assets we'll have a current asset of 180. Depreciation is the I suppose the fall in value of the current asset as they're being used. So our fixtures and fittings have a 10-year life, delivery vans have a 5-year life, they've been written off over 5 years. And fixtures and fittings, we've determined that they lose 1/10 of their value every year. So the expense, it's on cost. Both on cost and straight line are the same method of calculating depreciation. They're easy, they're nice and easy in that you just multiply the percentage by the cost. So fixtures is 1200, 10% by that is 120, so we'll have an expense of 120. And as well as that, in our non-current assets, when we show fixtures of 1200, we'll reduce them by 120 as well to show they've lost some value. Delivery van 20% by 2100 is 420 expense, and then we've got to remember to reduce our non-current assets by any depreciation. And then there was an error and reduced drawings by 680. Well, we have to correct it. Drawings at 680 put in mistakenly, so take it out of drawings, and it should have gone into office expenses. So office expenses is there. So then to start, you started your profit or loss account. That basically is sales minus cost of sales less your expenses. So our sales, we pick the figures in. There are cost of sales items, opening inventory plus purchases minus returns minus closing inventory. And all we're going to do is get a net sales figure and reduce our sales figure for these. So 41,970 minus 810 will give us our sales, and then take away our cost of sales to get our gross profit. So our sales figure reduces down. When we add up the purchase related costs or the cost of sales, they add up to 23,160. So 5 plus 22 minus that gives us this figure, and then we take 41,160 sales minus the cost of sales. And our gross profit is a nice even 18,000. Then after gross profit we add any other income, and then we take away all the expenses. So our other income is any other income received apart from sales income. So we've got discount received. You also might have interest received or rent received in a question. They'll always be on the credit side of the account. So gross profit, and then we just add discount received 930 to that, and then we take away all the expenses, and the expenses are those that we carriage out: rent and insurance, wages and salaries, office expenses, and we update them for the adjustments. List them all down. Don't forget to put in the depreciation that we calculated, and show your workings. They're the expenses. They add up to 16,000, which is here, and then our gross profit plus 930 other income minus all of these, which is 16,000, gives us a net profit or a profit or loss of 2930. And that is the end of the profit or loss account. And your profit or loss is your sales minus your cost of sales plus any income less any expenses, and you end up with a profit. The next thing we're asked to do was prepare a statement of financial position, which is just your assets, your equity and your liabilities. So we divide our assets into long-term and short-term. So we have non-current assets, we have two of them, we have fixtures and delivery vans. They cost 1,200 and 2,100, but we know they've fallen in value by 120 and 420 this year, so we have to show that. So that's how they'll appear in the questions. The cost less any depreciation. So in this question there was no accumulated, there was no old depreciation, but we'll see in further questions it'll often be more than this year's charge. It'll be all the depreciation for this year plus previous years. But this is the first year in business, or they weren't depreciated before, so that's why this agrees here. But anyway, our net book value, which is the cost less any accumulated depreciation, adds up to 2,760, and that's the figure we'll be using to add to our current assets. And our current assets are things like cash, receivables, closing inventory, and any prepayments. We remember to take away the provision for bad debts from receivables. We could do a little subtotal, but for the sake we won't bother. So our total assets are really all of these, your non-current assets plus your current assets, so the total is 18,570. And then in the bottom half of the statement of financial position, should be 16, we show the equity, which is just three things always: our capital, our profit and drawings. Our capital always from the trial balance, drawings from the trial balance, and we had that adjustment, so it reduces down to 2,200, and our profit is the bottom of our profit or loss account. All of these things belong to the owners, And then we add any current, non-current liabilities. There's no loans, but we do have current liabilities. Payables, bank overdraft, and we find them on the credit side. There's the payables on the bank overdraft, 4350, and then anything due, wages and office expenses. There. And they add up to 10640. Our equity is 7930. So the total of that is 18570. And if you wanted, you could have shown them. Get rid of that line. I don't like it. You could have, subtotal there like that, just to. So our equity adds up to 7930 plus 10640 is 1870. That's it. That's the statement of financial position, and we know it's right or somewhat right because the total of our equity and liabilities matches the total of the assets. So thanks for listening, and see you later.